But let's talk about the concerns when it comes to how much of your income is going to go to your shelter cost.
And one of the things in this higher interest rate environment that people have been talking about is the housing market. Obviously, higher rates complicates things for renters. It complicates things for mortgage holders. So there are a lot of people that are interested in seeing lower rates. But what was very interesting is the trend with home prices. Yes, they've come off their peaks, but perhaps they have not come down as much as some may have thought given higher interest rates. Ed Devlin is back with us, founder of Devlin Capital, senior fellow at the C.D. Howe Institute, and former head of Canadian portfolio management at PIMCO. How are you thinking about the dynamics in the housing market right now?
This flood of immigration post-pandemic has really complicated the situation, right? So normally I would have thought with interest rates moving up, 500 basis points, housing would have corrected significantly, and it's not. It's come off a little bit, but it's because of this immigration thing. I'm really interested in how the evolution of the dynamics between immigration and housing and immigration and productivity, because immigration and productivity is bringing in a lot of people, but a lot of them are at school, so school isn't producing a lot of GDP, right? The other thing is, how about these people have to live somewhere, and so these are dynamics that the bank, I don't think, really can control, but it does affect inflation, which is their primary objective, and so are they going to generally kind of look past it, or are they kind of very concerned?
If you're spending 50%, and most people out there are laughing at me because you're laughing at me right now because you're probably spending about 60% of your income on shelter costs. If you're spending that much on your home between heating and eating and repairing and your mortgage, if you're spending all that money in that place, where else are you spending your money? Not a whole lot of other places. That's part of the issue. We are going to see that in overall GDP because people don't have the money to spend in other places. Are people still spending money? Yes, they are. It's good old MasterCard and Visa that comes out of the pockets. And that's why the Canadian household debt has now risen to the same, actually above the levels that it was in the States in 2008.
I want to ask you about, Ed, though. You talked about productivity. What's increasingly come up is the fact that in this country, the fact that you have to commit so much of your time, your energy, your resources, your capital to housing, does that limit our overall productivity? It is ironic if you think about where we were going back to the financial crisis, where the housing horrors were in the United States. Canadians were not as levered as they are today. Our economy navigated relatively well. It actually invited people borrowing money to get into the housing market. And for some people who became homeowners, I suppose that was a big investment win. But here we are now with these deeply indebted households. Do you think that ultimately that plays a role in our longer term productivity? Just the fact that people have to put so much of their time and money towards housing.
Okay, let's look at this interview. There are a couple of interesting things to really look at and understand from a standpoint of if you're trying to figure out whether to buy, whether to sell, what is going on in your financial life. There's a couple of things to look at. First of all, interest rates are a part of inflation. Our inflation calculation right now that the Bank of Canada is using to decide what our interest rates are at, it's calculated in there. So if you take down our interest rates, you're going to see a lowering in inflation. Great point in the interview where he talks about if you lower interest rates, we're likely to see home prices going up. Yes, that is what happened. We've already seen that happen during the pandemic. They dropped interest rates, house prices went up. Why is that? Because the cost of borrowing that money becomes cheaper. You can't do that in a lot of different places, but you can do that when it comes to housing because you've got a secured asset. They're able to secure that lending against the property. Now, why are they doing that? Because they know that they can get the value out of it. So for all those people, if you're one of those people that are looking for housing prices to drop, you have to realize that that is not the mandate of the Bank of Canada. They are never trying to get us down to zero inflation. As they've said many, many times, they're trying to get us down to 2%. At a bare minimum, they're looking for home prices to on average go up by 2%. Forget about everything else. Forget about demand. Forget about supply. They're looking at a bare minimum of 2% a year. So if we saw last year that, or the year before, that housing was growing by 15% year over year, and now all of a sudden it's only growing by 3%, then what you need to realize is that 2% of that got stripped away by inflation, and the real growth was only 1%.
A client that wants to buy $1 million property, how much income do they need to qualify for that loan?
In this example, $1 million purchase price, I'm just going to say 20% down payment, it's $200,000. They'll give you a loan of $800,000 at a 6.875 interest rate. Your principal and interest on $800,000 would be $6,569 a month. Your taxes, that's another $1,041 a month. And then homeowners insurance, we'll say, is $200 a month. So your total monthly housing expense would be $7,810. If you look at a 50% debt to income qualifying ratio, you would have to make $187,500 a year, or about $15,600 per month gross to qualify for $1 million home with 20% down.
For starters, what this is really pointing to is, as a couple, you need to be making about $200,000 to be able to afford $1 million house, which in GTA is pretty close to the average cost. So if you want to be able to buy $1 million, you need to be, you and your spouse, your partner, whatever, you guys need to make it $200,000 a year gross just to be able to look at that. And you need to have that 20% down payment, $200,000. So, all right, great. You got both those things, off you go. You get to go buy that $1 million home. You don't have those, you're going to have to get into first-time home buyers plans and all these other different options. What income puts you in the top 1%? $500,000 or more. What puts you in the top 5%? $236,000 or more. What puts you in the top 10%? $175,000 a year. Now, yes, you and I, many people, those are combined incomes, combined household incomes. But it's just a bit to understand when this guy talks about you want to own $1 million home, you have to realize that you are committing both salaries just to be able to afford that. Do you want that home that badly? Or do you want a different standard of life? And that's why we're seeing more people than ever moving further out of the city, moving to other towns and cities to be able to enjoy a different quality of life. I'm not going to say better, but maybe a different quality of life, where a place where you can buy a home for $300,000 or $400,000, a place where you can go and you're able to drive to the beach or walk to the beach. Why are we seeing more Canadians now than ever before leaving and moving to places like Texas, going to Mexico? Because their dollar goes further than it does right here at home. But you have to decide, when you're earning your income, how are you going to split that up? What are you going to put towards building your wealth? Otherwise, the moment you stop earning, you start learning there's nowhere else to go and the government's not there to save you.